Welcome, everyone. It's Angelo Robles, host of the Angelo Robles podcast and the founder and CEO at Family Office Association. Today, we have acclaimed investment strategist Lyn Alden. I'm calling it our epic interview on everything investing. It's not going to quite be everything, but we're going to try. Obviously, it features Lyn Alden, founder and CEO at Lyn Alden Investment Strategy. Lyn, welcome back to the show.
Thanks for having me back. Happy to be here.
Great. And many of you know, and I would recommend listening to our first interview, which was December of 2020, so about 7 months ago. And most of my questions are going to be different, although I'm tempted to ask some of the same questions because so much has changed. But I think to make it more engaging for the audience, you could always go back to, it's up on my YouTube platform and watch or listen to it. Lyn is definitely among my favorites. I subscribe to her services. I really enjoy her deep intellectual approach. I do not agree with everything, but who does? So it's interesting to have a good conversation, maybe some debate. I have a truckload of questions. It will be way more than just Bitcoin and crypto, but it's going to start off that way. And on that note, why don't we begin? Lyn, did Elon Musk hurt institutional adoption of Bitcoin by saying it's not green?
I think in a small way possible, but I think the bigger picture for this kind of price action we saw is actually more tied to the Grayscale Bitcoin Trust. And so for people that are not familiar with it, the Grayscale Bitcoin Trust is, for a while been one of the only, publicly traded vehicles that you can access Bitcoin with for investors that prefer to access in a brokerage account. Institutional investors could also use it. And so in addition to people buying Bitcoin through that trust, there's also a neutral arbitrage trade there because it wasn't an ETF. It's still not an ETF. It trades, it's kind of like a closed-end fund. And so it can trade at a premium to NAV or discount to NAV. And for most of its history, because it's a rather unique vehicle, it traded at a premium to NAV. And so what people could do was they could, buy in at NAV with these 6-month lockup periods, right? So the investor would go out, get Bitcoin, give it to Grayscale. They basically buy into Grayscale at NAV, regardless of what the current market price is relative to NAV, with the caveat being they have to hold it for 6 months. And so for some people, they just were happy to be long that fund, whereas other people did it specifically for to collect the premium. And so what they would do was they do that action, get it at NAV, they'd short an equal amount of Bitcoin, and so they have a neutral position. And then after the 6-month lockup period, they can sell their GBTC shares, they can undo their Bitcoin short, and whatever the premium over NAV is, they get to collect that, and then they can do it again. They can do it every 6 months. And so when that trade's done, their trade's off. So they sold their GBTC, they ended their Bitcoin short, but Bitcoin is not redeemable from that trust. So that Bitcoin is permanently in the trust now. And so basically it converted liquid Bitcoin from exchanges into illiquid Bitcoin in cold storage. And so when that was repeated over and over again, it was kind of a Hotel California for Bitcoin. And so that was GBTC was the largest buyer of Bitcoin in the second half of 2020, for example. That's how big that effect was. And it's hard to know exactly what percentage of that was demand for Bitcoin versus specifically that neutral arbitrage trade, but certainly a component of it was that neutral part. And so now with GBTC having competition from the Canadian Bitcoin ETF, from some European exchange traded products, from easier, Skybridge Bitcoin fund, all these other things that are generally cheaper, Grayscale's now got a discount to NAV, and so that trade is over. There's no more kind of neutral arbitrage trade, at least in the long end. And so basically that biggest buyer is removed from the market. And so when we saw that happen back in, say, January of 2021, Bitcoin started to kind of consolidate for a little while, kind of made newer highs, but the momentum was kind of weaker. And then when you started to get that Elon, concerns, it kind of impacted a market that was already kind of, on its sideways consolidation. And so that kind of, helped trigger the decline. And so I think that played a role, but I think the more underlying thing was just a supply and demand balance for Bitcoin itself.
Yeah, I mean, ironically, and I'm not making this up, my next question after that one, I'm looking at it now. Did the end of the premium in GBTC signal a bear market in Bitcoin? But you did answer that. I am going to go back and push a little bit on the Elon and the green thing. You would know among institutional investors, they really look at ESG score. Some of this may trickle down more and more to family offices over time, and I would say likely will. It is going to be difficult, I think, especially now when things are a little rocky, to get institutional adoption. I mean, could Bitcoin be green? We would need to get in a deep discussion about, will there be a hard fork? Will the community allow it to happen? What will happen to existing Bitcoin? This may get interesting. If I could push you a little bit on the green initiative, could you paint a little bit of a bearish scenario to this?
Yeah, I think there's two separate risks here. So one is the how green Bitcoin is, and then the second one is how green Bitcoin is perceived to be and how that affects its investability. And so what I would kind of separate those two risks because I actually think a lot of the misconception, I think a lot of the kind of concerns around Bitcoin's energy usage are somewhat flawed. And so I actually think that the overall energy usage is pretty attractive, especially out of this after this recent move out of China, right? So I think it's actually going to improve. And so if you look at, say, Bitcoin's energy usage, it's something like 0.1% of global energy usage. And the way that Bitcoin scales, it'll basically over time use a smaller and smaller percentage of its market capitalization in energy. So even if the market capitalization grows, that percentage goes down. And so the absolute amount can go up, but the percentage goes down. That's what we've seen over the past 12 years and is projected out to continue. And so I don't really view that too much as a concern. But because we are in a very big wave of ESG investing, it's a really important part, especially for institutional portfolios.
For
I
sure.
do I do view that any perceptions around Bitcoin's greenness or lack thereof certainly can influence its adoption. And so, for example, we see one of the biggest new North American Bitcoin miners, Marathon. They were trying to, for example, deal with the fact that Bitcoin has transactions, and some of them most of them were from legitimate sources, but you can always have some from illegitimate sources. And so they were trying to filter out some of the illegitimate ones to kind of improve its say institutional attractiveness. Now that didn't work out very well. They didn't really increase their demand for that, and retail investors pushed back on it. And so there are challenges in kind of making the overall ecosystem kind of this neat and tidy package for institutional investors to be able to use. But overall, I think it's kind of a separate thing between it's how green is perceived to be versus how green it really is. And so, for example, I know a lot of miners in the space or financiers that are using Bitcoin, for example, to soak up flared gas, right? So gas that would otherwise be burnt into the atmosphere is instead being put into Bitcoin. So that's basically using an energy source that would otherwise be wasted. And so there's actually a pretty significant percentage of the energy that's used for Bitcoin is increasingly kind of going towards that type of thing, in addition to stranded hydroelectric resources and stuff. So overall, but because there are still, for example, coal plants being used to mine Bitcoin in some areas, less so now that it's coming out of China, but we still have some, for example, in certain, say, U.S. states. I do think that's overall kind of a public perception concern, both from institutional investors and from certain politicians, like, for example, Elizabeth Warren or some of the other ones that have used that, specific aspect of Bitcoin to kind of critique it.
Uh, I mean, I don't want to get into conspiracy theories too much, uh, but there maybe it's just coincidence. But all the things we're talking about, the China factor, Elon, we'll get to Kakistan in a second, uh, and knowing how central banks are, it almost made me wonder, is there a concerted effort to, I'm not going to quite say kill Bitcoin, I think that's impossible, but death by a thousand cuts and limiting its growth, if there was a coordinated effort, is very much possible. I don't know if that's more of a comment or a question, but I'd love to hear your general feedback.
That's a perception among some in the digital asset space that we've had an unusually high volume of kind of government pushback against it. And so, you had some in the US, some in the UK. Binance, for example, is being increasingly,
Okay.
regulated. China, they've had it's kind of a joke in the digital asset space that China bans Bitcoin every year, right? And it's always like, here's the Chinese Bitcoin ban of the year, and it never actually really has teeth. Yeah, I mean, it's been the biggest mining jurisdiction for I think at least 6 years now by far. But this latest one came from the highest level so far among those bands, one of the vice premiers. And so this one we're seeing from the hash rate, and we're seeing from all the other evidence on the ground that this one actually is effective. So very, very large percentage of Chinese Bitcoin mining is moving. They've also gone after some exchanges to basically try to sever it as much as possible from the banking system. They're probably trying to reduce competition to their new digital yuan, right? So they have kind of basically mining
For sure.
Bitcoin is a way for basically non-KYC coins from China. So it's basically a way that they can put in energy, get Bitcoin from nothing, not from existing exchanges, and then they could, potentially sell it away. And so they want to kind of limit some of those access points. But that's of course China. So in the United States and Europe, it's less extreme. We haven't had any sort of major actions to kind of, cut off Bitcoin from the banking system like you've seen in Nigeria or some of these other jurisdictions. But you have kind of like, like you said, death by a thousand cuts, bringing up ESG concerns, pushing back against all sorts of different, kind of aspects of it. And so I do think that there is kind of a somewhat of a pushback to kind of keep it in check to some extent, because it had this recent parabolic rise for the first time in its history. It's kind of a macro asset level, right? So as Bitcoin hit a $1 trillion market cap, as the whole space hit over 2 trillion, that's something that's now on more people's radars. And then especially when you have, corporations getting into it, institutions getting into it, it's certainly kind of it's hit the mainstream enough that I think that some jurisdictions wanted to keep it in check, especially ones that are, have somewhat less property rights, that are more kind of interested in capital controls or things like that. So we've had somewhat of a spectrum of pushback across the globe.
Bitcoin's dominance has fallen from approximately 70% to 45% since at least 2017. This was bullish, I would say, leading into that fourth quarter in 17. Can we still have a run of Bitcoin to 100,000 by the end of the year? We're all familiar with Plan B and his forecasting, but that's a pretty wide variance. I think he was like 80,000 to like 266,000 or something like that. Right now, it looks like 100,000 is going to be really, really challenging. But what are some of the metrics that you're seeing coupled with some of your opinion?
Yeah, so when it comes to Plan B's model, I find his charts very useful, but I've never incorporated the actual kind of price targets that he uses, right? So I find that the research is interesting, and I use it kind of as one of my observational tools, but it's not one of the primary metrics that I use in my own kind of forecasting. And so, I do think it's possible to hit 100,000 either maybe by the end of this year or next year. But it's, there's, like you point out, there's a massive variance there, right? So we are starting to see evidence of, kind of a bottoming formation around Bitcoin in the 30,000 range. That doesn't mean it necessarily is going to be, right? But it means that we're seeing kind of more signs that it might be. But until we break over the 41,000 barrier and kind of stay there for a little bit, it remains really in limbo from an intermediate trade perspective. Under the surface, we're seeing some, that basically the migration of hash rate is one of the more kind of bullish things under the surface. And so I actually think there's a lot of opportunity in some of the publicly traded Bitcoin miners, right? So Marathon, Riot, and so if those are companies are able to get all the miners that they've contracted out into next year, something like, for example, Marathon plans to 5x the number of miners it has between now and the end of quarter one 2022. And so there are a lot of interesting changes like that under the surface. We're also seeing, I've been covering the Lightning Network, which is the secondary layer that runs on top of Bitcoin for these faster transactions. And we're kind of seeing critical mass there where it's reached a level of liquidity and a level of apps that are kind of using it. So we're actually getting a kind of a parabolic increase in the usage of Lightning. And so that's, I think, long-term bullish for the network. And so I do think we're seeing a lot of kind of underlying network effect things that are still bullish for it. But it has to get through this period of kind of, distribution that's happening. We have to get, ongoing kind of regulatory clarity. And so I do think that it's a lot riskier than it was, say, in early 2020 when it was super cheap, when it was like, 7,000 a coin. But I do think that there's still kind of a lot of multi-year opportunity ahead for maybe a small percentage of a portfolio. And it could be Bitcoin, it could be some of the publicly traded miners. There are also private miners that, people that can do private capital with. And so there is a lot of kind of interesting space in there. For Bitcoin dominance, the tricky thing about that is it's a rotating kind of cast of coins that is always the ones competing with Bitcoin's dominance. So Ethereum has been the big one over the past 2 cycles. But in fact, if you take out Ethereum and you kind of look at what else is kind of eating into the market share, one of it is stable coins. So I actually don't count stable coins in terms of Bitcoin's dominance because they're more of a tool for people to access digital assets rather than kind of a competing asset. That's kind of an extension of fiat currency into the digital asset space. And so really I'm looking at things like, I mean, Doge was kind of kind of captured retail intention there for a while, even though it's got a lot of fundamental issues that, it kind of took some of the the retail buying pressure that might have otherwise gone into Bitcoin and Ethereum. Instead went into Doge. We also saw an increase in a lot of these kind of really tertiary coins like Bitcoin Cash or Ethereum Classic, some of these kind of derivative coins. We also see a lot of action among the DeFi protocols like Uniswap.
So, yeah.
Yeah, and so there is, a lot of the when Bitcoin's dominance was challenged last cycle, like the 2017, 2018 period, Ethereum was one of the big ones, but besides then, it was mostly different ones. And so, a lot of those failed since then, except for Bitcoin, Ethereum, and a couple others. And now the ones that are coming up to challenge Bitcoin and Ethereum are kind of a whole nother set. And so when we see Bitcoin dominance, we have to realize that a big chunk of that is rotating, failing, being born. There's a lot of churn in that other percentage that is kind of challenging those two top protocols. And so, for example, if you look at the Bitcoin to Ethereum ratio, Ethereum's gained a lot on Bitcoin since the bottom around, I think it was I think it was 2019 when it bottomed. However, it's still below its 2017 peak, for example. And so there is kind of this, I think that's probably a better ratio to follow, say the Bitcoin and Ethereum ratio, because you're at least comparing apples to apples. You're comparing kind of these two, say blue chip protocols competing with each other, whereas that extra space is this big kind of churning thing with a different there's different numbers of coins, and then the coins that kind of make up the largest percentage of that keep rotating over time.
We did have a question that came in. I'm going to keep my opinion to myself on it, but it basically was your opinion on Tether.
So Tether's challenging because, I mean, obviously from a regulatory standpoint, it's challenging. I personally don't hold Tether. I think there are other stable coins that you can use that are better accessed. Now, I think the question that some people have is how Tether could be impacting the prices of other digital assets. And so one thing that's important in mind is to separate accumulation volume from trading volume. And so Tether is not really used for accumulation. So people buying Bitcoin mostly in kind of these regulated exchanges like Coinbase, for example, and then bringing it to their cold storage or to Fidelity or to NYDIG, whatever the case may be. And so that's kind of accumulation volume. And then there's trading volume. And a lot of that happens in these offshore exchanges like Binance, for example, where Tether is used as a unit of account. And so, basically the biggest risk there would be that say there's outright fraud. So that Tether says, we actually, if they end up having far fewer reserves than they say they do. So the biggest kind of surface issue is that their reserves are not pure cash, right? So that they have a bunch of different assets, corporate paper, things like that, and so that they have a non-zero risk in some of their reserves, whereas their asset is being treated like dollars, and so that presents risk there. The kind of the less likely but potentially more severe risk would be that if they somehow don't even have the reserves they say they do, and that some of that is unbacked. If that were to ever kind of be, if Tether users were to doubt the reserves, you could have a flood of people kind of trying to pour out a Tether, and that could cause volatility in the space. And it's interesting because you can actually get upward and downward volatility in other assets. And so, for example, when you're trying to get out of Tether, let's say you had to do it quickly because it's actually unraveling, you could your ability to convert into fiat is slow at that point. It's limited. So you have to get into other digital assets. You can get into other stable coins. So their pegs might trade above their par for a period of time if you want to get into other stable coins. You also could ironically get a temporary spike in Bitcoin because you're basically getting out of Tether and into something that you know what it is, Bitcoin and Ethereum, kind of the blue chips. But then after that, some of that capital would probably then want to get out of the space. And so that whatever spike you got from people getting out of Tether would probably subside. And so if that ever came out, that would be a huge volatility issue. I don't see that as impacting the long-term structural case for Bitcoin as a network effect. But it is kind of that always on that radar as a potential, you could wake up one day and just the numbers could be all over the place because you have some news out of Tether or something.
Yeah, it's a great answer. Completely agree. The president of the Republic of Kazakhstan recently made amendments to the country's tax and budget payments code, introducing a new tax for cryptocurrency mining operators. Interesting for those that don't know how a lot of the Chinese miners moved to Kazakhstan and now they're looking to have some level of controls and taxation. I don't know if I could blame them, but this goes back to my earlier question, and I do not want to be Mr. Conspiracy Theorist, although it's hard not to sometimes. There appears to be some level of a coordinated effort, and that was a word that you didn't use that I used, relative to possibly the oppression on some level of Bitcoin. So you probably answered it already, but maybe now that we're throwing in Kazakhstan, your opinion about that.
Yeah, so that's interesting because it's been interpreted in a couple of different ways. So on one hand, there's a slight bullish aspect in the sense that it's Kazakhstan formally kind of accepting it, right? So if something's taxed, it means it's acknowledged. On the other hand, and also that tax is relatively small. It's a a couple fraction of a cent per kilowatt hour, but it's more about the kind of the probability that could be raised in the future, right? So at this level that was added, it won't kind of meaningfully impact mining by the profitability by too much. But now that that precedent's in there, they're saying, okay, what if they double it? What if they triple it? Or what if they keep raising it from there? It also opens the precedent where governments are more likely to carry out certain industries for taxation. And so, for example, right now, a Bitcoin mining company is already taxed, right? Like any other company, they have profit and loss. If they earn a profit, whatever they're at the end of the day when their accounting sorted out, they would conceivably owe tax on it. And then this kind of law is essentially saying we're gonna tax certain uses of electricity rather than other uses. Like we're gonna basically have a government preferred use of electricity and therefore tax certain types of its use more than others. And so it kind of opens up a precedent that I think spooks some of the Bitcoin miners, especially because once they get into a jurisdiction, it's very expensive to move tens of thousands of miners, and so they're hoping to stay in that jurisdiction for years and not have to relocate again like they've just done out of China. And so I do think overall that that could be something we see in more jurisdictions if the ESG narrative I think captures more kind of attention among regulators and policymakers. And one thing for my part, I'm planning on writing a article on Bitcoin's energy usage within the month to kind of look at it from like an engineering perspective, right? Because from what I've seen in media, it's often analyzed by people that are not very technical. They might not understand the scaling details of how it works, and so if they see headlines like Bitcoin uses more energy than a small country, which is true, but then again, so does YouTube, right? And so basically, it's one of those things where you can use kind of certain framing to make anything sound really bad, but when you actually run the numbers, run the scaling, it kind of tells a different story. And so I think we're gonna see this over time. We see for example, in the United States, we have the Bitcoin Mining Council now, and even that was somewhat controversial within the Bitcoin community. But basically, that's clearly an attempt to try to have another voice in the conversation. About how this kind of works. They're basically showing some of their transparency, right? So we actually see, for example, that among the sample they have, which is a very large sample, they're apparently using a higher rate of renewable energy than the general U.S. grid, for example. And so this is something that we'll see kind of different pushbacks one way or the other. It's partially tied to politics at the current time. And so it's going to be, I think, a big deal. It's one of the biggest kind of long-term risks for Bitcoin from an institutional perspective, I think, is that ESG angle.
For sure. A bit of a technical question, and maybe, again, I know you're Bitcoin, you're incredibly fluent on Ethereum. Very quickly, you got up to snuff on it. What effect will EIP 1559 have on Ether supply?
So that should be pretty bullish in the intermediate term. And so basically what that does, one of the differences between Ethereum and Bitcoin is that since inception, Bitcoin's had a very algorithmic monetary policy. They basically said that the new supply of coins is going to get cut in half every 4 years. It hasn't changed, and it's just kind of this sound money kind of principle that it goes through. Ethereum's different because from the beginning, they planned more rapid changes to the protocol. And so the developers put in difficulty bombs. And so basically that's kind of like almost like a kind of a mutually assured destruction that's embedded into Ethereum that forces both miners and developers and users to switch over and do these hard forks every once in a while to kind of keep the development going. And so, basically in Ethereum, the developers have more control, so they can change monetary policy more than they can in Bitcoin. And so there's actually kind of almost like a central bank of Ethereum in the sense that you can actually change monetary policy with less difficulty than you can in Ethereum. And so that's been one of the critiques against it. But in this latest proposal, they want to try to have a somewhat more concrete monetary policy where there's going to be a deflationary component, which is that some portion of the fees that are sent to miners will be burned, right? So basically be a way to destroy Ethereum. On the other hand, there will still be a issuance, and that issuance will be based on how many Ethereum are being used to validate the network over time. And so as there's kind of a couple steps here. So one is to doing that kind of inflationary deflationary protocol. Then they're trying to shift to proof of stake. And so there's kind of a multiple steps here. But over time, you should have a more consistent monetary policy with a very low amount of issuance. So one of the long-term questions there is, okay, so you have now kind of a quantitatively sound monetary policy, but then from a qualitative perspective, it's can that be trusted? So will they change it again in the future, right? So if they changed it before, can they change it again? And so that should be kind of bullish in the intermediate term. We're also seeing that because ETH2 is being rolled out and it's kind of got this unclear deadline for when it's going to happen. It's kind of gotten delays over time. And so with ETH2 staking, basically what people are doing is they're taking their Ethereum tokens and then they're locking them up into this smart contract where they're basically earning a yield to help kind of verify and secure the new kind of ETH2 beacon chain, kind of the new core blockchain. And so what that's doing is it's kind of taking liquid Ethereum and moving them over into being illiquid Ethereum, because once they're in that contract, they can't come out. And so they kind of get locked away. And so it's almost a similar effect you saw like with Grayscale, where just, it's basically this one directional flow of liquid Ether to illiquid Ether. And so I think, at least it could be one of those things that's to sell the news event. So once Ethereum 2 is kind of rolled out and that Ethereum gets unlocked, it could ironically, be a sell the news event where now you get out of your position. But at least until then, that's a pretty strong upward price pressure for Ethereum, because you'll have ways to convert liquid to illiquid Ethereum with ETH2 staking, and then in addition you have the EIP 1559, which should be a more disinflationary monetary policy than Ethereum's had in the past.
And everyone, this is going to be a very long form interview. I promise it will be more than just a digital asset ecosystem, but there's just so much interest with families getting more active in it. And this is some pretty complex stuff we're talking about. I felt it would be valuable for many of you, but I promise it will be diversified. Related to that, at least how I'm going to ask it, will Ether reach parity market cap with Bitcoin in the next 5 years? And I am going to give you a part 2 to that. Will Bitcoin be BlackBerry to Ether being the iPhone?
So I think the first question is possible, and I think the second question is unlikely. And the reason for that is that they have two very different use cases. So, like I said before, the main thing about Bitcoin is that it's out of all the blockchains, it's kind of the one that achieves sufficient decentralization, meaning that it's very, very hard to change. And most of the development happens on the extra layers. And so, Bitcoin did just do an update called Taproot, but that'll be the first major update since 2017 SegWit, and it got over 90% consensus. So, in order to update Bitcoin, it has to be almost unanimous, and it's more incremental. So there's, instead of kind of one central development hub, it's this very kind of slow update process. But that's exactly what you want out of, say, digital gold. You want to know with high certainty what it's going to be like. It's also purposely simple by design to maximize security, right? So it's not Turing complete. And so overall, it has fewer attack surfaces, fewer opportunities for bugs. And whereas a lot of development can happen, for example, there's now smart contracts on Bitcoin with RSK and Stacks 2.0. There's Lightning Network, which makes it faster and kind of more usable on that secondary layer. And that's where a lot of the rapid development can happen. Whereas the underlying protocol is kind of like Fedwire, where it's this system that's kind of the foundation of the system that's not kind of being rapidly changed. It's more for these large settlement transactions rather than, say, buying coffee with it. Whereas Ethereum, they're trying to do more on the base layer. And so that comes with technical risk, right? Because you're I've described it as like you're changing the engine while you're driving because you're changing over from ETH1 to ETH2 at the same time as you have competitors, Cardano, Solana, these other Binance Chain, although they're obviously facing some issues now. But basically, there's a lot of other smart contract platforms, and one of the issues there is that there's pretty low switching costs for smart contracts, and so if there's say one of them gets high fees, as you've seen out of Ethereum lately, then stable coins and other things can spill over onto other smart contract platforms. And so, for example, speaking of Tether, Tether in its early days used to run on Omni, which ran on Bitcoin. But then when Ethereum was launched, Ethereum was a better suited blockchain for that purpose. And so Tether's moved over to primarily running on Ethereum. But when Ethereum started to become expensive, you started to see Tether migrate over to Tron, of all things. And Tron's not it's a more centralized blockchain. And so overall, you kind of have this kind of shift towards lower fees and more centralization, which kind of it's almost like you're competing on cost, which is not a good place to be in. But Ethereum still has a very large developer network effect. It's got the up there with Bitcoin. It's the top two overall kind of network effects. It's got the most transaction volume of any blockchain. You have basically a lot of tokens running on top of it. So it's got that kind of network effect. And so basically what you're comparing is a network effect to low switching costs, tons of competitors. And so overall, I view Bitcoin and Ethereum as being quite different, with different use cases and different risk profiles. So one of them is the kind of the purpose is simple foundation. I think the best analogy is TCP/IP for the internet, right? So that's been around since the 1970s. We're not radically changing the underlying foundation of the way the internet works. It's literally all it's over 4 decades old. I'm pretty sure 4 decades from now, or at least 2 decades from now, it's not going to having changed much. We rapidly change the thing on the top of the surface for TCP/IP for the internet, right? So we're changing the application layer all the time, whereas that underlying tech is not rapidly changing. So Bitcoin uses that model, right? So there's lots of happening on the surface, whereas the foundation's kind of steady, whereas Ethereum is more kind of trying to be more ambitious on the base layer and do more things on the base layer, but then taking more risk by being Turing complete, by being more centralized in terms of development, and having more competitors from other smart contract platforms. So, I think that I don't really view them as kind of a one versus the other phenomenon, but it is possible that Ethereum's market cap could rival Bitcoin's in time.
There is a question that came in from Harley. Harley, I'm going to repurpose it a little bit. To what extent, if any, did the US government's ability to follow the money, the Bitcoin, and the ransomware attack on the gas pipeline from about a month or so ago, that's how these people get paid? I've always argued it's not as anonymous as people think it is, or it's pseudo-anonymous. If the US government, with its full power, and this is a company that the Koch brothers own 40% of, I might add, and they're pretty influential. If they really, really, really wanted to find it, they could, and they did pretty quickly. That actually spooked some people. What's your opinion about that? And did that possibly impact Bitcoin's price?
It's possible that it did, and it's one of those things that can be, again, viewed bullishly or bearishly depending on, because there's a couple of variables there.
Right.
And so there are blockchains that are more optimized for privacy, like Monero. And if anything, they would get on regulators' attention, pretty fast, right? Because it's a privacy coin. It's kind of made for that purpose. Now they have to achieve certain. You have to have basically less security, less verification in order to have those privacy features. And so Bitcoin's base layer is quite trackable, and therefore it's pretty bad for using for crime. And so, there's that firm Chainalysis. They're often employed by law enforcement, for these sorts of purposes. They do studies every year. They show that a very small percentage of Bitcoin's transaction volume is estimated to be for illicit activity. And for that reason, I mean, if you're going to do illegal activity, a suitcase full of cash is better in most cases. If you're using a digital one, then maybe Monero or something like that. Whereas Bitcoin is quite trackable. Now, there were some false reports there where not only were they able to track the funds, they were able to get the funds back. But that's because those funds were not transitioned to, say, a cold storage wallet. And so if they were transitioned to a cold storage wallet, it'd be almost impossible to get those funds back unless they could track down the people. They could track down that wallet, for example. Whereas apparently those hackers left their coins on a hosted wallet, And so that was able to be accessed either from an exchange or from the host provider. You can basically do backdoors if it's kind of hot, it's not cold storage, it's hot storage. And so overall, that impacted in some ways the narrative a little bit. On the other hand, it showed that if anything, regulators, should have less to fear from Bitcoin from that privacy perspective, because Bitcoin's really not for that purpose. It's more about sound money, about kind of applying software to the money system, right? So we're seeing with Lightning Network, we're seeing with El Salvador remittances, for example, things like that is less suitable for nefarious activity. Now, over time, when you Taproot update will somewhat improve the privacy a little bit. And so over time, Lightning transactions could become increasingly private. And so you can almost have like parts of the Bitcoin network that are almost like Monero in the sense that they're much harder to track. And until recently, Lightning Network had low liquidity, so you can only do very small transactions with it. But say hypothetically, 3 years from now, 5 years from now, and Lightning capacity has been going parabolic recently, and so if that becomes increasingly usable, and you can do larger transactions with Lightning and with Taproot, they're more private. That could open up again. It ironically could make Bitcoin better for privacy, which could then also bring more regulator heat against it. And so this I think you have a spectrum there between on one hand the kind of the initial like cypher punk movement, the kind of the people that founded Bitcoin, they'd prefer to be as private as possible. On the other hand, privacy invites regulatory pushback. And so I think that there's different blockchains for different purposes. And overall, the current configuration of Bitcoin is not really optimized for privacy and not really optimized for criminal activity, even though some of the narrative still focuses on the Silk Road days or on Bitcoin's relatively small usage in crime.
Since Ethereum is moving to proof of stake, you mentioned that earlier, will miner extracted value become irrelevant?
Well, for Ethereum, so basically, Ethereum miners are going to have to shift away from it. They could mine Ethereum Classic. They can do whatever they can repurpose their GPUs. One difference between Bitcoin and Ethereum is that Bitcoin's miners use dedicated equipment, ASICs, whereas Ethereum miners use GPUs, and so those can be repurposed for other activities. And so overall, basically Ethereum's going to transition to the validation model, right? So you use Ethereum tokens to verify the Ethereum blockchain. It's got that kind of more circular aspect, whereas it's not the miner activity. Whereas Bitcoin is staying with that miner model, and so definitely in the Ethereum ecosystem, it's going to be headwinds for Ethereum miners once that eventually rolls out. Although there's still no clear deadline for when Ethereum 2 is going to be fully implemented with proof of stake.
True. We had a question come in. It's coming in from someone who must know a lot about cyber and issues. It's pretty deep. Is the secret network better than Monero since downloading tails isn't required for privacy? Allegedly, if you download tails, you end up on the NSA watch list.
Yeah, it's not something I cover too much. I mostly cover Bitcoin for its usage as a store of value, for its effects on payment networks. I cover Ethereum for smart contracts, stable coins. I cover some Ethereum competitors for those reasons. I think there's a lot of interesting things being developed on those. I generally am not kind of focused on the technical details on privacy as much as some people focus on. So I'd have to pretty much pass on that question.
And I have one coming up that is very much a newer development. I know little about it, but I took some notes on it. I'm probably going to mispronounce it. The Ducat, DUCAT, is that something you're familiar with as a Wyoming DAO?
No, I'm not.
I'm going to ask the question because I think it's important for my audience to at least they could say they heard it from my podcast first. Then we'll get to the next question. It was basically going to bring up the American Crypto Fed DAO, DAO, it's the acronym, is legally recognized by the state of Wyoming as the first decentralized autonomous organization, aka DAO in the United States. Will the DUCAT, was the question, which was granted, this is an important part, granted DAO status in Wyoming, so a stamp of approval from the government, become the new TIPS, and inflation and deflation protected by stablecoin with unlimited issuance constrained by algorithms targeting zero inflation and zero deflation. Very interesting. My question was going to be, how is this not get banned? I find it interesting, things with governments, their involvement from central bank digital currencies, Bitcoin, and how they may say one thing, but pay less attention to what they say and more attention to what they do. Uh, why don't we save that one to this comes out more fully? But I think it's very interesting what's happened, and maybe very good, by the way. I'm just surprised it's there, and we'll see how it plays out in the coming months.
Yeah, one thing I would add is that Wyoming in the U.S. has been one of the most progressive jurisdictions for basically trying to be a hub for this type of activity, and so they've been spearheading, say, Bitcoin banking. They've been basically being the place to bring Bitcoin, Ethereum, all these other kind of places. So along with Miami, that's also been kind of vying for that role lately. It's one of the handful of hubs that are kind of more on top of that than other places. We've also seen, for example, Kentucky has tried to attract miners in some ways. And so, a couple of these states or a couple of these cities have spearheaded that. And so that is kind of something to keep aware of, that you have these somewhat of a jurisdictional arbitrage where some places can be more hostile to it. Other places are saying, hey, then come here, then we have cheap energy, or we have friendly Bitcoin banking, kind of jurisdictions, stablecoin allowances. I think there's a couple models here. So there's like the Chinese model of, say, central bank digital currency, top down, trying to push out competitors. Some people in the United States are kind of trying to focus on another direction, which is for the U.S. to harness the private sector as much as possible for their monetary policy, to basically have a regulated set of stablecoin providers, and basically to use that kind of private sector technology as much as possible when relaying their various policy objectives, rather than kind of resorting to that more Chinese model of having Fed coin, for example, and then pushing out other competitors. And so I think that's going to remain an ongoing question for years. I think as we go forward, to see what is allowed by regulators, what is not. There's all certain things like Binance offshore exchanges or Tether, those types of things being more frowned upon, whereas things like UDSC, like Circle, and some of these, say, Wyoming-based entities, because they're going through the more kind of official process, they have a higher chance of being kind of accepted. We also saw, for example, that some of the initial coin offerings of 2017, they came under regulatory fire for unlicensed selling of securities, whereas now, for example, we saw Stacks 2.0. They saw what happened to those other ones, and when they came out with their offering, they went through the full regulatory process of basically selling securities. And so I think over time, as certain protocols are made example of, there's been more of a shift to try to do things above board as much as possible.
Any opinion on the Ducat, by the way, is built on EOS. Do you feel EOS, as I call it, EOS, is centralized?
I view it as centralized to a significant degree. That was one of the popular coins of the 2017 bull run. It's not in the top 10 now, last I checked. It's one of the ones that's lost some of its luster, but it's still obviously a functional network. It's still used heavily in the crypto gaming space. And so overall, I think one of the risks of most of these blockchains is that they can have the appearance of being more decentralized than they are. And so I think when you start, say Bitcoin is arguably the most decentralized in terms of, not just in terms of node distribution, but in terms of, say, the breakdown of powers between nodes and miners and developers, and kind of, there's really no kind of central Bitcoin company that can just change things. Then Ethereum's, I would say less decentralized than Bitcoin, but say that's still more decentralized than something like Tron or EOS. So there's certainly a spectrum here of how decentralized these protocols are. And as you get out of the top couple coins, you generally shift more towards centralization in one way or another. It doesn't necessarily mean that the coins are concentrated in the hands of a few, but it could mean basically the ability to change the protocol is easier to do, or somewhat more centralized than some of these other protocols.
Do you think that Solana could be the next Ethereum?
So it's possible, right? But again, they're making sacrifices in order to increase transaction throughput. And so one of the challenges of Ethereum is that they're a second generation coin, trying to make changes while running to be a third generation coin, while these other coins are coming out as third generation coins. So Cardano, Solana, like these other coins are coming out with these changes in mind that Ethereum's already kind of shifting to. Now the problem is if you try to do too much on the base layer, you make sacrifices. And so, for example, if you want to run a Bitcoin node, this laptop that I'm talking on, I could run a Bitcoin node on it. Whereas like I could not run a Solana, node on this laptop. It's a more kind of high end thing. It's not really something that is. It's more enterprise grade, you could say. And so that's the thing is once you get up to coins that are trying to have a lot of throughput on the base layer, in terms of how big the blockchain can get, how much how much bandwidth internet you need in order to keep track of all the transactions, keep your node synced. Those become more industrialized. And again, that is one of the variables of decentralization. That if you have to have a very high bar for being, an operator of that network to be able to verify the supply or to be able to contribute to some way to the blockchain, that centralizes it. And so there is kind of every variable in blockchain space, there's always a trade-off. And so it kind of matters what that protocol is optimizing for. And that's again why I kind of separate Bitcoin from these others, because they're all optimizing for different purposes. And so that's why some of these I don't view as direct competitors. Whereas, for example, Ethereum and Solana, Binance Smart Chain, those are more direct competitors. And so things like stable coins or smart contracts can spill over to whatever is cheap, being highly used, so it has a network effect. And so I think the biggest challenge for Solana is they are up against the biggest network effect in the space, at least in the smart contract space of Ethereum. So there's kind of older tech but bigger network effect versus newer platform but smaller network effect.
And I don't know if it's something that you've done some research on, but like NFTs kind of came from nowhere last November and December. Are social tokens the next NFTs?
We've seen it. Yeah, we've seen a few rounds of this. So, if anything, the earlier kind of popularity of NFTs was a game called CryptoKitties back in 2017. That was
Mhm.
kind of the fad of that cycle where you could. It's almost like Pokemon. Like you could trade these little digital cats. They were funny looking. And it was actually such a big thing that it actually clogged up the Ethereum block space for a while. It drove transaction fees up because so many people were trading these cats. And so obviously that faded away. But we saw the round two happen this past year with the same idea being applied to digital artwork. And I think overall, the market's going to keep trying things until it sticks, right? Which is natural. And so CryptoKitties didn't stick. NFTs will, that's yet to be seen. That's we haven't, we certainly hit kind of a bubble phase there. It cooled off. It remains to be seen how much that's going to stick. Social tokens are another thing. I don't have a strong perspective there, but I do think that this when investing in the space, basically it's one of those things. There's going to be a lot more misses than there are hits, but some of the hits can be very, very big. And so it's one of those things where the space it can be scammy. It's prone to failure. But there are a lot of well-meaning projects out there that are trying to apply software to things that previously software is not applied to. So I don't have a strong conviction on that, but it's something to watch.
Yeah, like one of the questions coming up eventually is going to be on asymmetrical trades. You can't lose more than what you put in, but your upside may be tremendous. That would potentially be one, if I could call it a sector. So keep an eye on it, everyone. I find it interesting, but there will be lots of losers in it. So I have no secret tips as to what's going to take off. Probably Rally is one that some people in my audience are familiar with. It's intriguing, but again, make your own decision. Is the debt ceiling a headwind for the stock market?
It's certainly going to be a headline risk for the next couple months. And so at the end of this month, the deadline approaches, but then they start juggling the books a little bit in order to push the actual issue out a little bit further. And it's one of those things where, I think I saw a statistic since 1960. It's been raised. I think it was 29 times under Democrat administrations, 49 times under Republican administrations. It's been this thing dozens and dozens of times, but in recent decades, it's been more politicized. And it's one of those challenges where that debt ceiling is all about previous kind of obligations rather than future obligations. But politicians treat it as kind of sending a signal about future obligations. And so I do think overall that's a risk. I mean, it basically can add bond market volatility. Bond market volatility necessarily spills into equity market volatility. And so overall, I do think that's a, kind of a curveball to watch as we head into the late summer and early fall, because that also can impact things like, you know, part of the market is based on this inflation versus deflation question, and that's in part tied to stimulus or no stimulus, right? So if there's going to be infrastructure bills or
For
not,
sure.
and so that is an ongoing question. And so debt ceiling debates at least delay infrastructure type of activities. And so that it has multiple kind of downstream effects based on the answer to the question of how long this kind of debt ceiling, event's going to take.
Will carbon futures, ETF and ETNs, continue to outperform the S&P?
I'm pretty bullish on them. So there are people that have covered those pretty closely. Like Rao Pao had a thing on Real Vision where he had a guest that was an expert in that space. So for people that have it, you can recommend. I'd recommend that. I know
Yeah,
Marin Katusa
sure.
has been kind of pounding the table on that space. So there are people that cover that more closely than me. But from my research, that I do think the thesis is sound, and that there is still probably outperformance potential in that space. And perhaps more importantly, it's somewhat uncorrelated with some of the other investments out there. And so as a small slice of a portfolio is something it's more of a political question than an economic question. And so it's gonna follow its own path.
You mentioned it indirectly a little while ago, are we going to have inflation or deflation, say short or long term?
So I think we're going through cycles. And so right now we're in kind of peak base effects. So we have the most recent data was compared to the same period from a year ago, which was the most disinflationary part of last year, because that was kind of the heart of the lockdowns. And especially because obviously inflation data is reported with a lag. And so when we're talking about May and June data, we're talking about May and June data of last year. And so, those base effects will start to subside. So we could start to see lower headline year-over-year CPI. So we hit 4.99% for May, reported in June. It's unclear if we're going to hit that level again, maybe a little bit lower this time because the base effects start to get a little bit harder. But there's a couple of things to keep in mind. One is, that level of inflation happened even with oil prices still pretty constrained. And so if we were to, in the years ahead to get, a genuine shortage in oil, that'd be a pretty big, impact to inflation. Another thing is that, rent is a big part of CPI, and rent, even though it's positive year over year, the rate of change has been decreasing. But if you look over the longer term, that tends to follow, say the Case-Shiller home price index with a lag, say a 12 to 18-month lag. And so there are signs that looking out a year or a little bit more, we could start to see rent turning up. So we're actually already starting to see that year-over-year change in rents are kind of showing signs of bottoming a little bit. And if that starts to roll up, that's another potentially upward pressure on inflation. We also see that there's wage pressure still going through the market. Now by September, when some of these extra benefits wear off, that might subside, it might not. It's something that certainly an area that I'm keeping my eye on is some of these gaps between, say, job openings versus jobs being filled, reports from businesses of how hard it is to get the labor they need. And so I think basically that, the inflation that we experienced, there's kind of, you can separate transitory and rate of change terms and transitory and absolute terms, meaning that, a lot of the prices that are being increased, they're not going to come back down to where they were. So for example, when Chipotle raises prices 4%, that's a new high, that's a new watermark for where those prices are. They're not coming down. Now, other things like lumber that had more specific bottlenecks, that would parabolic. It came off really far. I kind of doubt that it's going to come back all the way to where it was, say, in 2019. But same thing with copper, right? So copper's been less extreme. It's off of its recent high, but I don't think we're going to see it come all the way back down. I think basically a lot of this will end up being a stepwise increase in the prices of certain goods and services. But I do think the rate of change of those price increases could start to cool out as we get back to more normal opening, as we get past some of these kind of big demand shifts that happened. But the next kind of variables to watch for maybe the next round of inflation could either be energy price constraints from, going back to the ESG conversation. There is less investment in the oil and gas space. Drillers being more disciplined, right? So they have less access to capital. They're also less willing to, dilute themselves. They're more focused on shareholder returns. And so, we've been in this period for the past, say, 7 years of general over oil abundance. Whereas I think, as we get further into this decade, I think that could get tighter, and that could put, more upward pressure on some of those prices. And basically, some of the market share could shift a little bit more towards the sovereign players, because some of the private sources are kind of, getting less investment over time. And so I think, looking at wages, rents, and energy are the next kind of variables for potentially keeping this inflation story alive longer than some of the people think, in terms of it, say, going away by the end of the year. So overall, I do think we're going to be in elevated price inflation for a period of time, but probably not at this current rate of change we're experiencing now, from a combination of base effects, used car prices going parabolic, stimulus effects still in play. So I think that'll cool off to some extent.
I mean, what's your opinion? I guess it's meant to be just a little tongue in cheek. Are influencers, and I could argue Elon Musk with a tweet is definitely an influencer, but more traditionally, are they eating the world, and how does this affect us as investors? I could say that Charlie D'Amelio, the TikTok star that has what, like 90 million, I may be underestimating it, followers, had more followers than Biden or Trump had votes.
Yeah, we're definitely seeing that, especially among, we've seen a lot of coordination over the past year. There's Wall Street bets, there's TikTok influencers. And so historically, out of social media, Twitter has kind of been the area for investors.
Right.
Whereas, recently the rise of TikTok investors, and you end up with very different audiences. So the TikTok space is more about the retail space. And I think that the longer term risk there is that a lot of that was driven by the stimulus. And so a lot of them had more time on their hands. A lot of them got, cash handouts that they could use to invest in the market. And so if you look at, say, U.S. personal income over the past year, it was above trend for most of the past year. Especially, you got these spikes when the stimulus checks were sent out, and as that starts to wear off, a lot of those, maybe not the influencers themselves, because a lot of them are very well off now, but a lot of the followers of those influencers, they, are unlikely to keep having that inflow of cash to invest at the same rate that they were over the past year. And so I do think that effect could weaken to some extent, but overall we clearly are in this effect of influencers. So pretty much whenever, we have influencers among CEOs like Elon Musk. Part of Donald Trump's success was his massive
For sure.
social media presence, and so we are, for whatever space you work in, having a huge social media following is a big factor, and that can move things. I mean, it's no secret that Elon, if he tweets about a, Dogecoin or Dogecoin Junior now he's been promoting, the price of that thing goes vertical as soon as he tweets it. Now there is somewhat of a diminishing effect, and so for example, Elon was able to drive the price of Dogecoin up, but as it kind of started to cool off, he couldn't really keep it at that level anymore, and so kind of the subsequent effects got less and less, and so I think over time these things kind of go in cycles, where an influencer is unlikely to be able to kind of persist at that level that they have been over, say, multiple years. You kind of rise to the top, and you start to kind of cool off, and then another batch kind of winds up somewhere else, and so it's kind of this rolling thing to be aware of, and so you have to adjust according. So, for example, hedge fund investors had to adjust to the fact that there could be coordinated attacks on heavily shorted companies over the past year. And so I think it's one of those things, when you look at influencers, it's important to get your information from multiple sources so you can see where maybe some of the capital is moving, but be aware that it could be somewhat ephemeral. That some of the forces that have made that possible the past year could get wear off in, say, the year ahead.
For sure. And we're about halfway through the interview. Normally, I do some of this at the end, but I don't want all of you to check out. So, briefly, for 20 seconds, I'll say, and we're very fortunate to have Lyn on, and this interview will be up on YouTube. I'm pretty active, maybe not quite as active as I was earlier in the year, but hopefully with really special guests. So, there are deeper dives from people like Michael Saylor to Lynn to James Altucher and many, many others, and other amazing. We actually have upcoming this summer a 90-year-old lady that we're going to have on, who's a very active investor, and very active in crypto. So stay tuned. That's coming up. There'll be a lot of fun. So you could follow us simply on YouTube. Yes, on YouTube. We're Family Office. So don't look up the Angelo Robles podcast. That's technically my podcasting platform. That's fine for Apple and Spotify. But on YouTube, it's Family Office. And I'm surprisingly pretty active on Instagram. It's our full company name, Family Office Association. So go and follow on there. I'll follow you back, I promise. Uh, the super rich that don't adjust in 20 years, will their wealth be decimated by investing in the old economy, while the cyberpunks and digital asset ecosystem will drive massive, massive returns as the old centralized finance gets upended by DeFi, decentralized finance?
There's certainly a risk to that sort of thing. If anything, if you look over the past decade, if you were invested in, say, the S&P 500, but not the top 5 stocks, you had a radically different performance than, say, investing in the full S&P 500, or especially if you were concentrating in those areas. Like, you mentioned Michael Saylor. I mean, his book, The Mobile Wave, like 9 years ago, kind of predicted some of those massive network effects arising from technology reaching a certain point. So once we had not only the internet, but the ability to, everybody has smartphones in their pocket, they can use the internet on the go. We had a massive rise in some of these companies. And so I think it's going to be similar over the next, decade or two, where there are going to be areas of disruption. And so there is a risk to wealth if it has zero exposure to some of those areas. And so I think, one of the most tangible examples is that, historically, if you look over the long term, if you look at Treasury, real interest rates, either for T-bills or long duration Treasuries, uh, you know, most of the past century, for example, more often than not, the rates are positive, but there are periods where they're deeply negative. And so the 40s, the 70s, and then the 2010s were all very negative, real rates for T-bills. And then so far, since the 20, over the past kind of year and a half into this, start of this decade, even long duration treasuries are below the inflation rate and below the inflation expectations rate. So even taking into account the fact that some of those transitory effects will wear off. And so a lot of pools of capital are invested in large amounts of bonds or cash. I think that is at risk of being gradually devalued over this longer period, like we saw in say the that say U.S. federal debt as a percentage of GDP was this high. They kind of have no choice but to run inflation hot and keep those yields lower, right? So it's essentially financial repression. And so people that are overweight bonds are kind of vulnerable to that positioning. At the same time, that forces investors to go out on the risk spectrum, and they risk getting caught up in bubbles and losing capital that way. And so I do think that over the next, say, couple decades, it's important to maintain some degree of diversification, but to make sure you do have exposure to some of those new areas. So certain tech companies, certain things that are happening in the digital asset space. I do think it's important to have a non-zero position. But even some, for example, old world things that didn't perform well recently, like the 2010s were a very bad decade for commodities for the most part. But I do think the 2020s are likely shaping up to be better for the commodities. We saw that obviously earlier this year. We saw a big rise in commodities. We've been cooling off because that got quite heated for a period of time. But I do think that going forward, there will still be opportunities in the commodity space. I don't think that this overall run is done yet. And so I think it's one of those areas where you probably don't want to have, say, a pure 60-40 portfolio exposed primarily to older industries. I do think it's important to have some of these asymmetrical bets embedded in your portfolio to benefit from some of these new areas, or for some of these older areas that just haven't seen a lot of outperformance lately, but that are probably positioned to be pretty important going forward.
Will the FANGs plus Microsoft and Tesla still be all powerful the way we consider them now, looking 10 years out? But how about blockchain and DeFi disruption that I mentioned earlier, the rise of anti-aging and biotech? Let me phrase, that's the broad general question, probably a part two. You have to pick one. Which FANG plus Microsoft or Tesla is likely to fall off that market dominance first?
I think Tesla's overvalued. compared to its fundamentals. It's a very hardware-focused business. So I think that has some of the strongest kind of weaknesses at the current time. Netflix has also lagged. But I do think, for example, Amazon still has a lot of long-term potential at current levels. And Microsoft is rather expensive, but I think the cloud trend is going to continue for a long period of time. So those, basically among that axis, I think the Amazon, Microsoft, Facebook side potentially has a longer runway than the rest of that FANG group. Now, if you're talking 10 years out, I think the shape of that could change somewhat. And so, for example, you could have certain regulatory breakups happen where, say, let's say Facebook is forced to divest Instagram and WhatsApp. Possibly you see a separation between Amazon's cloud business from their retail business.
Right.
You could see Microsoft forced to divest some of its assets. You could see, basically there's a couple different risks there. So you could see that you could be one of those things where the market cap of all those is actually bigger than they are now, but that it's broken into more companies. So that's I think one reasonable possibility of happening. You could have Alphabet's even looking into potentially IPOing some of its assets, right? So you could have these companies either voluntarily or involuntarily get broken up to some extent, and so they might not have the same names they have now, but I think the overall market capitalization is going to be there from most of these companies. Another kind of, but on the riskier side to watch is that a good chunk of these companies, they kind of arbitrage the fact that we were willing to give up our data for conveniences. Basically to have free services that we enjoy, we're willing to give up our data, and so those companies got access to cheap or free data and made a lot of profit from it. And so when you start to see kind of pushback against that, you have things like the Brave browser. You have some of the digital asset spaces are about monetizing your privacy, essentially. That
Right.
instead of monetizing things with ads, you can either donate to websites on a one-time basis to read an article, or you basically sell your attention, like the things you're using your data, right? So it's basically returning power to the user. And so if those continue to gain steam, especially along with some regulators kind of pushing back against some of this big tech, I do think that there is risk there. But if I were to guess, based on how I see things headed, I would expect that most of the market capitalization will still be there, still be very big 10 years from now, and it might just be in a slightly larger set of companies than the ones we see right now.
Will China surpass the US, and when? And I guess why?
Well, so in terms of population, they have that advantage. So they can have a much smaller GDP per capita and still surpass us in terms of absolute GDP. And so basically, in terms of purchasing power parity, they're already roughly at where we are now. And just in terms of nominal GDP, they're not. And so they've already passed us, for example, as being the largest commodity importer.
Mhm.
And so for the longest time we were by far the largest commodity importer, and now China is. And so for many of the places we buy oil from, now China is their biggest customer. So they're certainly increasing their political sway. I think they could eventually surpass us in overall commodity consumption, overall electricity production and consumption. I think there's a good chance that by the late 20s they'll pass us in absolute GDP. Now, there are other limitations that make it very hard for them to surpass us in other areas. And so, for example, their geography is inherently constraining compared to North America and the United States in particular, right? So they have much less coastal access, and they have much, they're reliant on food imports to some extent. If you look at, say, the size of China, it's about the same size as the United States, but a lot, bigger chunk of China is virtually unusable compared to the United States. And so overall, they have a lot more geographic limitations. And so, for example, I think that their ability to project long-term force has a much longer time frame until it could reach kind of the status that the United States has, and say in terms of, say, blue water navy. But the risk there is that as we get out further and further into the future, in some ways, with the creation of, say, hypersonic missiles, and with the increasing importance of cyber attacks, that kind of old school naval strength is potentially less important over time. And so overall, I do think that China is going to eventually surpass us in some areas, But it's, I think we're going to have a world of more regional powers where, in the South China Sea area, they'll have more dominance than they have now. Whereas, their ability to project power far away is still going to be somewhat limited.
Interesting. We'll get back to some of that, including the cyber part, if we have time later. Everyone always says, think for yourself. It sounds great. It's a question I asked Michael Saylor, but how do you learn? Or is it you're born with it? I would think more learn. How do you learn to think for yourself? And did college help you?
So, I mean, college certainly helped with it because my degree was in electrical engineering, so obviously it helped with the technical foundation. But overall, I mean, mostly learning comes from passion. If you're passionate about something, it's far easier to learn at a very deep level. And so what I've used the example before that when I was younger, I tried to learn music. I tried to learn how to play guitar, and I just didn't have a knack for it, and I had trouble getting through like a long practice session, and just kind of I wasn't really making progress at a rate that I'd expect. And it's because I just didn't have the passion for it. So it's like in some ways I wasn't born with it, but then also whatever I wasn't born with, I also just wasn't able to kind of build momentum on it. Whereas other things just inherently drew my interest, and therefore my ability to learn is by being interested enough to take the time to go deep into spreadsheets or deep into research documents and just kind of start from the ground up and just kind of put in that time commitment to learn something. And each person has their own learning method. So some people are more visual, some people are more reading based, some people are, each one has their own kind of process. And so I'm pretty numbers based, and so I like to go to the raw data sometimes and look at that. I like to chart things out, use spreadsheets to get an idea of how something scales. What are the bottlenecks going to be? Obviously depends on the topic. And so that's how generally I learn, is by trying to focus on areas that I'm passionate enough that I can spend days or hours just kind of digging into something in a very deep level and just kind of starting afresh, like starting reading other sources, but then taking all those pieces together and then trying to model it or trying to quantify it so that you can have different narratives, but when you actually see the numbers, sometimes you figure out which of the narratives are true or which percentage of each of them are true in different contexts. And so I generally am just numbers based.
So part of that, in terms of what you call passion, others may call simply just being curious. And that's an important part of it. A question, we'll stay on that topic a little bit. And you did a very technical in terms of, did you say electrical engineering?
Yes.
Uh, with the technologies we have today, I would assume that you could have learned that technical capability remotely on YouTube. Actually, if you're a faster learner, maybe you could have even done it at 2 times speed and got it quicker in your own accord. I know you got the social interaction in college, the independence from parents, but in terms of the education, which I'm basically asking, is education going to be disrupted? You probably could have got that technical capability without ever stepping in a classroom.
I think so. And another example I can use is that my master's was in engineering management, financial modeling, that sort of thing. And for example, at that point, I'd already taught myself discounted cash flow analysis and these other things like that because I had passion, I had access to the internet, and over my younger years, I learned all that. So the time I actually got to classes where I was applying those engineering economics, applying those discounted cash flow analysis, I was already in a position where I could just if some of my fellow students were having trouble with it, I could help them out because I already learned it previously. And so I do think that most information can be learned online now. It's kind of a big democratizing force for access to information. And certainly if I was say hiring certain types of people, it'd be more about their capabilities than say what degree they had. I think that's kind of the direction we're heading in the sense that 4-year degree is maybe not as strong as it was in the past, and it's more about what you can do, and how you've proven that you can do it. Whereas before the degree was kind of the proof, whereas now it's about getting your foot in the door and then getting kind of practical proof.
In terms of thinking for yourself, and again, electrical engineering, your interest in the world of finance, would psychology and even philosophy classes help students to think for themselves arguably be more creative than linear learning relative to more mathematical principles. Part of it depends on what they want to do in their career, of course.
I think, I mean, obviously understanding logical fallacies and how to avoid them is important for any field where decision making is important. In addition to just kind of understanding, yeah, understanding how to think, understanding different approaches, different, say, in philosophy, you learn different foundations of ethics, different foundations of how to think, different just kind of you can think of them as platforms, and then you can kind of choose which platform is say most relevant to a certain situation. And so obviously, philosophy gives you a toolbox to draw from, and a lot of soft skills that are, whether you go into law, whether you go into finance. I do think that those skills are important, in any sort of, high performing career.
You mentioned Doge, a meme earlier. Well, a meme coin, I'll call it. The impact of memes for the younger generations, especially Gen Z, gets me in trouble when I say this. I'll try to be a little more politically correct. It's practically religious, zealot-like, which has led partially to the extraordinary growth of Doge. Do you think these things that are meme-centric, as we know them, are kind of here to stay and they are impactful?
I think so, but I think it's you can separate something that is only built on memes versus something that has a solid foundation, then the information about how it works is spread via memes. And so what I mean by that is, there's that old saying like a picture's worth 1,000 words. And so a meme is essentially a picture, often with a small amount of text, and it often makes an analogy to a movie or to an existing meme. And so it actually conveys a lot of information very quickly to people that are familiar with that meme template or familiar with with say the movie or the work that it references. And so kind of like a chart can give you a lot of information very quickly. A meme can display a lot of information very quickly, and it could be like an analogy that you're trying to get across in a funny way. And so that combination of humor, analogy, and visual stimulus naturally is that way to virally spread information. And so I do think that method of sharing information is important and probably going to be here for a very long time. Now, the risk is when something is has no foundation and it only exists in meme form. Well, that's when it's vulnerable to being ephemeral, right? So something has no foundation. Like for example, if you look at the development of Bitcoin versus Doge, Bitcoin has a much larger network effect, much more developers, much stronger security model, far more decentralization. If you look at GitHub, I mean, the updates that are happening to Bitcoin and all those layers on top of it compared to Doge was basically, wasn't really going through any updates, for example. The developer community is pretty much dead. The whole thing started as a joke. And so, you know, Bitcoin is something that I would say, as an example, has a strong technological underpinning. And then, especially in some markets like retail users, say the information about that foundation is spread in meme form, whereas say Doge doesn't really have that foundation and only exists as a meme. And so I think that separating those two is important. That's how I'd phrase is that it is likely here to stay as a way of transmitting information, but only about eventually reality catches up to things, and that if the foundation is not there, eventually the meme ceases to kind of have influence.
There's a question coming in from a participant. Like memes, are there other techniques that you use to share information? Interesting research regarding the neurological impact of storytelling, as an example.
Yeah, so my preferred foundation for sharing information is very long form articles. And so, anybody familiar with my work knows that I write 3,000, 5,000, 10,000 word articles that might have 25 charts in them. And it just kind of, I try to like, if I'm going to write about something, I try to just like make it kind of the kind of the de facto guide to that thing that I'm writing about. And obviously some topics I'll go into more detail than others. And so that's my preferred method. But for example, let's say I make a chart for an upcoming article, I'll share it on Twitter. And so charts obviously do well on social media. They're very, they're visual stimulus. And other times I will share a meme just to be kind of to spread humor. And those actually tend to get the most engagement. And again, because you're harnessing the combination of humor with making a point. And so it's obviously you have to the point you're making has to be true or resonate with people. But then when you make it in a funny way, it can spread very, very far and get a point across, because it's almost like instead of writing several paragraphs about your point, you're basically tapping into like a meme template is already known, so people already know there's a lot of information already embedded in there, and so the relatively small amount you're changing in order to share an idea means that you're already taking a lot of information and just repackaging it slightly. And so it's actually a very efficient way to kind of share information. And often when I share charts or memes, I'll get, I'll see the comments, I'll get questions and stuff, and that ends up being useful for when I make a long form piece that actually write everything out in kind of that long form strategy, because I already see their questions, I already see the comments, and that gives me an idea of what people are thinking, what they're curious about, what misconceptions they have. And so that actually is it's almost useful for both sharing ideas and for just getting engagement and using that as a research tool.
There is a saying, he who holds the gold makes the rules, is a new rule. He who controls the money supply makes the rules. So are the true world leaders the central banks?
Well, I mean, if anything, this past 2 years showed us some of the limitations of monetary policy, because it's what's been more impactful over the past 2 years was the fiscal side. And so one of the points I've been making is that, say QE alone is not very inflationary, but QE combined with the fiscal stimulus, that's a more impactful thing for both the economy and for potentially inflationary effects. And so the 2010s were kind of characterized by less fiscal and more monetary policy. But once monetary policy was tapped out, brought to the zero bound, asset purchases only go so far. They lack a transmission mechanism to get their stimulus to everyday person, right? So the Fed can't just decide to give out money to people, whereas the Treasury can. They can say, okay, there's an emergency, so we're going to either cut taxes or we're going to give unemployment aid, we're going to give stimulus checks, and so the central bank's still involved because they're financing it, right? So we're basically doing deficit monetization either directly or indirectly. Um, but really, that kind of division of powers is what we saw that this past year. The fiscal side was really kind of the one that really I think had a bigger effect on markets. And so we saw early on in the pandemic, for example, when the Fed came out with, I think they said 500 billion in QE. They did all this, and the market just fell. It just ignored what the Fed was saying. When we started to get news about the CARES Act coming together, for example, that's when markets started to rally off of that kind of crash bottom. And so I do think, if anything, this kind of showed some of the limitations the central banks have, at least under the current legal structure. Now, if they have, say, digital currencies and they can bypass the fiscal route, then that kind of combines some of those divisions of powers together. So that'd be a different story. But I do think, if anything, this kind of shows some of the limitations that they have.
Any opinion as to why some very prominent and successful investors, Bill Gates, is buying so much farmland?
So farmland historically has been a good investment. I did a chart a little while ago, a few months ago, showing that if you normalize money supply per capita in the U.S. and the price of farmland, it's almost the same chart since, like, the past, like, say 40 years. And so generally farmland is a good inflationary hedge, not just against CPI inflation, but against actual monetary inflation. And so the money supply going up on a per capita basis, while also generally paying out a small dividend. And so it's never generally a very cheap asset class. So you don't get, say, a high dividend yield like you would with some other industries, but that combination of being inflation hedge that kind of pays you to own it, so it has a positive carry, generally does a similar thing that gold does, if not better. And just the fact that it's not portable, and it's got obviously some differences. And so Bill Gates made headlines. It's interesting because he became one of the largest farmland owners, but he still actually owns a very small percentage of total U.S. farmland. And so it's actually a rather distributed market in many ways, where even the biggest owner of it doesn't actually own that much of it. And so I do think that is a kind of an interesting long-term opportunity as kind of a real asset inflation hedge.
Will We kind of mentioned this earlier. You had an opinion on Amazon and its AWS. Could I make the argument that blockchain, that DeFi in general, decentralization, could be a threat to AWS's dominance?
Well, the funny thing there is that a lot of those a lot of those blockchains run on AWS. And so, for example, a very big percentage of Ethereum is running on AWS. And some of those, there's actually like, because some of those have, difficult node requirements, you see services like Infura, right, for Ethereum. A lot of that's based on Amazon Web Services. And so, you know, again, you have the risk of, you can have the appearance of decentralization, but then actually when you go down to the core, it's actually less decentralized than it looks. And so I think that's something we're seeing in some of these blockchains. And so I don't view them yet as being anywhere of a threat to something like Amazon, because if anything, they're hosting a lot of it. Now it is, if it gets more regulatory approval, obviously things like DeFi can eat into certain financial services like lending. Basically, it's applying software to do something that is otherwise a more manual process. And so I do think it can eat into certain types of insurance operations, certain types of lending operations, certain types of
Middlemen.
exchange operations, again, because we have these decentralized exchanges. And so to the extent that regulators allow it, I think it's a risk. Now, a bearish thing to express is the fact that part of why those services have been so successful is because they're kind of doing regulatory arbitrage. And so, regulators have been slow to catch up with some of these, right? Because it's fast moving technology. And so regulators can only move so quickly. And so, a lot of DeFi usage, for example, let's say decentralized exchanges, a lot of that, there's, I've seen, evidence or reports that basically there's not a lot of people tracking their taxes, for example, when they're using those decentralized exchanges. Whereas if they're on Coinbase, it's a more regulated environment and you're more likely to get caught if you're not doing your taxes properly. And so if you have, say, let's say hypothetically two exchanges, one's highly regulated, one's not, and so people are going to flock to that unregulated one as long as that's kind of allowed to have that existing, where one is being held down by regulations, one's not. But then when regulators finally catch up to that other one, then the use case for that other one gets diminished. And so, for example, people during some of these high volatility periods, some of these people were paying very, very high fees to trade on a decentralized exchange, like hundreds and hundreds of dollars in many cases to make a straightforward trade that you could make for much lower cost on something like Coinbase. And it, it's one of those things where decentralized exchanges are also supposed to be, better in those environments where, say every time there's a volatility event, you have some of these major crypto exchanges, they kind of go illiquid, right? So they stop working properly.
Yes.
But then ironically, some of the same things happen on the DeFi ones where just there's so much transaction fee issue that they get blocked because there's only so much blockchain capacity, especially
Right.
for say things like Ethereum. And so a lot of the things that they purport to solve, sometimes they don't solve them. And so it's, if anything, once regulators kind of catch up with some of them, it could kind of keep them in check to some extent because they're kind of benefiting from that regulatory arbitrage where their traditional competitors are more constrained by regulations than they are. And so they have, tax issues and things like that. Whereas I think as regulators catch up, that's a risk. So I don't really view them as a huge threat to Amazon, and still not necessarily to some of their centralized peers.
Have you looked into, researched, and have an opinion on investing in psychedelics?
So I'm not an expert on that. I do think that that is a very undertapped area, and there have been some recent public efforts on that. And so there are, I think, really good interviews out there that other people have kind of focused on. I know Mike Green interviewed, I forget the gentleman's name, but he interviewed someone who's heavily involved with bringing one of those companies public, I believe. And so I do think that's a really interesting area to look into. I'm just not the right person.
What percentage of allocation should a family office that, hopefully not FOMO, they've done some research and have a thesis, even if it's one sentence, should make putting their toe into Bitcoin? Should it be Bitcoin and Ethereum? Should it be what I would probably argue, Bitcoin, Ethereum, and Solana? It's probably too easy to say, well, $1 billion family liquid 1%. Well, that's still that's $10 million. That's real money. Do you think part of it depends on the AUM, the risk tolerance, obviously, but they should do something? And again, the argument that Raoul Pal and others have made is if it goes to nothing, you may have a glass of wine and not be happy about it, but it's not going to impact you. But the asymmetrical opportunity relative to where you're pulling the money from to put it in there may be so much better. It simply is worth the trade.
Yeah, that's how I view it. So my argument since 2020, since early 2020, has been that we're probably at the point where zero is not the right number anymore. And so since early 2020, I've been making the case for a non-zero allocation, at least to Bitcoin, and then from there, I think they can ramp that up depending on their conviction. So I think 1-2% is kind of the going rate now, where I think it's you'd want to not have less than that, most likely, unless you for whatever reason had a particularly bearish conviction about it. But then from there, depending on how knowledgeable, obviously any pool of capital has to tilt their capital somewhat to what they know more. And so, some people are going to be naturally more experienced with equities. Some people are going to be naturally more experienced with say bond markets or commodities or things like that. Certain regions, right? So certain jurisdictions they might have more experience with, more comfortable with. And so some degree of diversification is important, but that you also want to tilt to what your specialties are. And so someone who, for example, for whatever reason, has been interested and has basically spent the time commitment to learn about the space, if their conviction grows, if they become bullish on it, then upwards of 5% or more could be in it, because they're at that point they're making a more conviction bet rather than just a diversification bet. So really that the actual range you have in it could vary greatly depending on the purpose. If it's just kind of say, you own a lot of old world companies, you want to hedge that position, 1 or 2% to have that exposure is useful, and then dial that up if you happen to be highly convicted about the space and knowledgeable on it.
Somewhat of a related question. We could go down a rabbit hole and make it the remainder of the conversation. We won't, but spending a minute to 90 seconds on it, what are some potential other asymmetrical trades? I'm going to define that to simplify it as being you may lose everything, but you're putting in such a small amount that risk is worth the reward, because it's probably, if it goes up, it's not going to be 5 or 10%. It's going to be noticeable. We did mention social tokens, which I would put in that camp, but most of my audience is not familiar with it and has no knowledge about it. And purchasing it going on blockchain browsers and Uniswap is going to be above most people, although it's really not that hard. You could learn it. But what are some ideas or trades that you would have?
Yeah, so one I would say is the public Bitcoin miners like Marathon. It might be worth, those could be quite asymmetrical if you have another big run up in some of these protocols. If you go outside of the space, I still think longer term uranium is an interesting play, where when you have periods of weakness there, I'd be buyers of those periods of weakness, because kind of like carbon credits, you have a rather uncorrelated bet, right? So compared to other commodities, uranium's kind of less tied to the inflation narrative or the economic cycle, and it's more tied to simply, when nuclear civil utilities begin their acquisition cycle to renew their longer term contracts. And so right now they have pretty low, the number of years they have worth of supply is near their low end. And so they're going to have to increasingly start a contracting cycle, based on most industry research, at a time when the price of uranium spot price is below the cost of production for most new mines. Other than some of the largest kind of existing mines, the cost of bringing new production online is pretty low. And currently, there's more uranium demand than there is production, but that's being kind of taken care of by the secondary supply sources. And so overall, I think when you look out 5-10 years, I think having a non-zero position in the uranium sector is useful as a asymmetric, uncorrelated bet. And so that's, along with some of the digital assets, is one of the areas that I've been emphasizing to some extent.
Unrelated to that question, some questions that are coming in from our guests, our viewers. Do you have an opinion, and I would keep it a brief summary, on Polkadot and Cosmos?
I don't have a strong opinion. I've not looked into them too closely. Again, it's one of those situations where each one has trade-offs. Each one has the risk of low switching costs where things can migrate to newer projects over time. And each one percentage-wise has a low survival rate to the next cycle. And so the number of tokens from the previous cycle in 2017 that is still like really viable, popular products is low. Obviously, Ethereum is one of them. Bitcoin's one of them. Rather few others are. And so just be aware that when you invest in the space, the ones that become kind of permanent winners have a high multiple, but there will be a lot of failures. And so there are experts other than me that have kind of dive into those individual projects at a closer level than say I would. I know, for example, Alex Saunders of Australia, he specializes in kind of sorting through some of these smaller protocols and basically, providing research for his clients on that area.
If you had to live, Lyn, outside the US, where would it be and why?
I mean, that's challenging. I mean, maybe in the Caribbean somewhere. I think I like the North American continent area, right? So I think there are other jurisdictions in the area that I'd like to be in to have access. Um, I think probably that's what I would go with. Probably a Caribbean type of area, maybe a Central American type of area. If I was, because there are, or say South American in certain areas, because there are some of the more sane jurisdictions there that you have the benefit of. It's a cheap place to live. You can get a lot of, you can go a lot with your money in those places while still having, say, attractive atmosphere, rather stable jurisdiction, and then still have access to North America pretty readily.
We asked variations of this question before, and I have relatives that are in college in the world of finance, and they kind of asked me this question. So I'll kind of turn it a little bit around to you. About to enter the world of finance, shouldn't college kids be learning a hell of a lot more about the metaverse, crypto, blockchain, NFT, social tokens? They're not going to get it, probably even at Stanford or MIT. This goes to the value of think for yourself. How are you a self-learner? Of YouTube, a little bit of what I've done, and YouTube was a part of it in reading. I'm not sure by the time colleges catch up on that, it may be 10 years.
Yeah, I think it's one of those things. You have to be a self-learner in this environment. I mean, we have unparalleled access to information that even 20, 30 years ago would have been much harder to access. And, it's one of those things. I mean, even when I was in college, for example, I did an engineering degree, but I also started my first, say, investing website back then. And ironically, now it's the investing side that really took off. So it was my self-learning that eventually became my primary career rather than the engineering. And so basically, even if you're in a formal program where you're learning, it's important to have your own thing on the side because that's your alpha. That's your source of, if you're just in class and you're acing that class, you're still capped by what is being taught in that class, and you're not differentiating yourself. Or if you're going out and you're learning something that is maybe ahead of what's being taught in the classroom, that's an important place to be. And I mean, schools are starting to catch up. I mean, I was invited to a handful of different MBA classes where I've given some kind of one-off lectures to some of these programs, and I'm not the only one I know. So there's certainly other schools doing it with other people that have kind of developed a niche somewhere, and so there are that is trickling into schools, I think. But if you're trying to get ahead, I think it really is important to start studying outside of school as well, and you can even go public with it and start developing your own platform, because that can be helpful for finding jobs. That can be helpful for starting your own company, making contacts in the industry, right? So you can go out, not only learn but also share what you learned on the side.
Related, and of course, a fairy tale question, but in today's times, right now, if a Lyn Alden was 18 years old, about to enter college, and you had 10 minutes to talk to her, again, not going back to when you were 18, but you're 18 right now, what would be some general, probably, if you want to include life advice, that's fine, but more so on business and purpose and just how things are changing? What advice may you have?
I think it's challenging because a lot of the things I ran into, like the downsides, were important. They were kind of like key learning things, and so there's actually very little I would change. It's one of those things where if you were to, it's one of those jokes where like if you were to change the past, like you could change something that seems like you're taking away a bad experience and making it a good experience, but that could actually end up taking away 5 good experiences because it didn't lead
True.
to certain growth aspects. So I would not want to risk touching anything. I'd want to just like leave it as is and let it play out like it has, because any even seemingly positive thing could change that. But in general, I think I would kind of reiterate that what I'm doing made sense. Basically, have my own thing on the side from the beginning, and be a self learner, be a self starter, and be willing to share it publicly. From the beginning, because you learn by teaching, right? Because one thing I found is that, so one of the benefits of school is that you're forced to complete things, right? You're tested on it. You have to get through it. And so you can't, there might be something you don't really want to learn, but you have to learn anyway. And so one thing I've found is that if I'm writing an article about a subject, it almost is like the same effect as going through a class where, if I'm just learning for something and I'm not sharing with anyone, there might be parts that are hard or parts where that are boring, and I just kind of skip them, and I just kind of don't go into that part, and I kind of focus on what's fun. Whereas if I'm writing something that 100,000 people are going to read, right? Then even those boring or hard parts, like if anything, I have to spend extra time on those parts to really get it, so that when I share it, I'm not sharing misinformation. I'm not, say, doing something embarrassing. I'm basically laying it out, and it's kind of this. It's like that's my test at the end of the year, right? So I'm basically going through that kind of external process to force myself into something, and so in many ways, teaching is important to learning, because it helps you find your own gap. So if anything, I would say, to my younger self, like keep doing what you're doing, keep not only learning things on the side, but also you trying to share things on the side, regardless of how many people are reading it.
Excellent. Uh, Market caps of in US dollars, I guess, maybe oil is, I think, about 100 trillion. Real estate, public stocks are going to be larger. I don't know if that much larger. Uh, in 5 years, that's probably going to be too short of a window. Will Bitcoin and Ethereum be in that range? A much, much, much larger, much larger market cap than now.
Yeah, I mean the numbers you said, I think that's still high for 5 years from now for Bitcoin and Ethereum, but I do think that unless a major tail risk happens that somehow disrupts them, like some sort of major draconian crackdown in the U.S. or something. So tail risk aside, my base case would be that the whole digital asset space is multiple trillions, that Bitcoin is probably multiple trillions, that there's a good chance Ethereum will be multiple trillions, and stable coins, the total market cap of stable coins will be much larger than today, most likely. I would like to see it in some of those other vehicles besides Tether, rather than say, because there is systemic risk when you start to have any one stable coin being worth a certain amount of money, especially if it's say collateral's not as kind of rock solid. Um, and so I do think that overall space is likely to be much larger than today, on the order of several trillion. If you think about it, I mean, we now have individual companies worth over 2 trillion, that could conceivably get to 3 trillion in some cases, and yet you have, say, Bitcoin, which is a monetary network that is, potentially has a higher cap than any of them. And even Kathy Woods from ARK said he thinks that Bitcoin, for example, is a bigger idea than Apple. That basically the market cap could be bigger than Apple, in the long run. And I think that is certainly possible. And so I do think that these are headed. I think they're eventually probably going to get zeros added on to where they are now, in the longer run. I don't know about 5 years, but I do think that they're going to be much higher than they are now in 5 years.
Yeah, I mean, that generally when families that are maybe a little older, a little more conservative ask me, and I don't know who the winners are going to be, but some of the ones I mentioned earlier, I think would likely still be here. I said, likely there is tail risk, uh, a concentrated global government, significant crackdown where they're coordinated. So sure, there are definitely risks that could happen. And who knows what else, nuclear war, a whole bunch of things that could go wrong. But to think that we're going to go from what, analog to digital back to analog, and these aren't going to progress is just, it's pretty foolish. Now, yeah, in 5 years, is it going to have that market cap? Boy, that'd be great. I'd love it relative to how I'm invested now. But realistically, that may be, I don't know, a decade or longer. But it appears to be trending. Just don't quite know who the winners are going to be in that direction. To not admit that, I just think it's like having your head in the sand. A little bit related. Will Vitalik Buterin, founder of Ethereum, for those that don't know, be the richest man in the world in 5 years?
I mean, I think it's possible. I think there's a good chance that Jeff Bezos could still be the richest man at that point. Or I know the top few people have been varying a little bit. So Elon Musk briefly had it. Bezos has been flirting up there. I do think some of these really large Bitcoin owners also could be up there, like the Winklevoss twins, for example, if some of the numbers work out and they go up pretty significantly. So I do think overall, some of these people in the space, whether it's Vitalik, whether it's some of the big kind of owners of exchanges or owners of Bitcoin, I do think a lot of them will be much higher on the Forbes list than they are now. I also think if you look out far enough, I think the next say 100 billionaire might be someone we don't know yet that's in the bio space, right? So I think that
Yes,
I think basically there will be a Jeff Bezos of bio, and so I think that's
for
gonna be
sure.
probably another big area to be aware of.
Yeah, we didn't have enough time today. We probably have. Can we have a little bit past 4 o'clock?
Maybe briefly, but yeah, I gotta wrap it up a little bit after that.
Okay, so we'll keep it to 4:05. Uh, what asset class for the remainder of this year among the most common 8, 9, 10 that most people would look at do you think would be the best performing?
So I try not to do a lot of 6-month forecasts because my framework is really more about finding things that are multi-year, good risk reward balances. Whereas if you're looking at a 6-month period, you're at that point you're close enough. You have to take into account technicals more. You have to take into account, say, political outcomes that could happen one way or another. And so there's more kind of those tactical variables. Um, I do think that some of the under this year are looking interesting. Like some of the healthcare names, I think they've been kind of left out of this reflationary cycle. So I think as some of that wears off a little bit, I think some of the valuations in the healthcare sector are pretty attractive. Um,
Mhm.
I do think still that there's upside potential from, say, Bitcoin and the rest of that ecosystem. And so, like I said, some of the miners, I do think that that's going to be a very interesting space. I'm increasingly liking some of the miners here because of that hash rate migration that's happening. Um, and really, beyond that, there's certainly going to be some political decision points like debt ceiling or infrastructure bills or the Chinese credit cycle, right? So China's been on like a tightening cycle lately that's been slowing down both Chinese domestic economy and as well as it's impacting global, because we're all interconnected. And so there are kind of these political decisions as well as Delta variants, whatever thing can happen from the virus. There's these kind of curveballs that can come that are almost, very challenging to predict. And so that's how I play the next 6 months. I'm still remaining quite diversified. I'm still bullish on Bitcoin and some of the miners, and I'm also just some of the healthcare names. I think, in fact, not even just the smaller ones, but even some of the blue chip healthcare names that have been acquiring some of these, promising therapies. Some of them I think are just too cheap right now and that they have good, say, 5-year perspectives. And I don't know if they're going to do well in the next 6 months or not, but especially with some of the kind of the euphoric aspect wearing off, especially among retail investors that are maybe having less capital, I think some of these names that don't interest retail investors at all lately, like the blue chip healthcare names, I think those could eventually have a period of doing quite well.
What country first develops advanced quantum computing? Will they have a tremendous and perhaps nefarious edge?
Well, I mean, if you were to develop quantum computing stealthily and then deploy it, I mean, for example, people often ask how that would impact Bitcoin. But for example, anything that could break Bitcoin, you could break bank encryption, uh, and and and
Right.
and so basically the entire modern system as constructed, uh, get down to the foundation of banking, would be potentially impacted security wise by quantum. And so we've seen a lot of hacks lately, but those are generally these unencrypted things or poorly encrypted things. We've never seen like a catastrophic banking hack, for example. Their system's been very robust, and so if that were to develop, that would obviously change a lot of things. Now, there are still a lot of headwinds for that technology. And I mean, statistically speaking, if anything, I mean, the ones that have an advantage would be, say, the Americans, just because it's one of those things, sheer numbers, right? So the more technology companies you have working on it, the greater chance that it's going to be in your jurisdiction, right? So the chance that it ends up being a small country is low. So United States, potentially China, but so some of these kind of, you know, more powerful tech countries are the ones that are likely to eventually have that technology first.
Why are the gold miners, Barrick, Newmont Gold, paying dividends instead of reinvesting in gold? Is this an indication that they are bearish?
So I would say no, and I think an important difference between this gold cycle versus the 2011 gold cycle is that during that whole run up in gold prices, gold miners kept acquiring new reserves, they kept expanding, they kept making acquisitions, and that's partially what ended that cycle. Basically, there was so much euphoria, there was a lot of new supply brought online, and they managed to. I mean, gold went from say 300 an ounce all the way up to 1900 an ounce during that cycle, and those gold miners managed to not be profitable through that entire cycle. They managed to not really kind of retain free cash flow, pay off debts. They managed to end up with more debt than they started with and not being free cash flow positive. And that's because it was so rapidly redeployed, often at uneconomic rates. And so now, and then of course, they had a brutal bear market. A lot of those managers got replaced. A lot of the weaker ones got acquired. And if you look at Barrick, for example, they had a ton of debt. They've rapidly, they paid off a lot of that debt, built up cash, so their net debt is almost zero. They have almost as much cash as debt. They've radically improved their balance sheet strength. They've radically improved their free cash flow, and so basically less. They're being far more disciplined with their reinvestment because they've learned from the past cycle where they just dramatically underperformed the price of gold itself. And so, if anything, I think they're being far more cautious, and you could interpret that as bearish, but I interpret that more so as cautious and kind of appropriately cautious, where they're finally focusing on being these free cash flow producing companies, at current gold prices, and so they're not inherently speculative. At least some of these gold ones, you could treat a Barrick as a value stock, rather than treating it as a speculation. We're also seeing that to some extent in the midstream energy space, and kind of the North American energy sector broadly, where despite these higher oil prices, because we have less capital going into the space, there's less kind of incentive to keep drilling and finding new supply. And so they're more focused on being free cash flow positive, returning cash flow to shareholders. We see the midstream companies. I mean, that whole model, the whole MLP model is based on rapid growth and issuing more and more units. But after the blowup that happened, say with the oil price crash from 2014, 2015, they've shifted to being self-financing. And so you have them increasingly becoming free cash flow positive. You even have a couple of them do unit buybacks. And so you have like Enterprise Product Partners that used to be a net issuer of units is now kind of neutral to slightly downward in terms of how many units it has, because the shift is more towards being self-sufficient, self-financing, and returning cash to shareholders. And so we're seeing that in a couple different commodity spaces.
7 minutes left before I go into the close. I have three questions. We'll keep them a little bit lightning quick. Did the DDIPO and potentially canceling of the ByteDance IPO make investing in Chinese ADRs off limits?
I don't know about off limits, but it certainly, I think, should increase the prudence that investors have to them. Be careful about position sizes, and have a higher threshold for ones you're willing to invest in, with maybe a lower position size than you otherwise would.
Are interest rates heading back to 1%, or let me be shocking, 3% or more?
Do you mean the short end or like the 10-year?
10-year.
So I think, it's unclear, but I think a general pattern we're going to see is that it's not going to closely follow inflation, and that most likely the 10-year is going to spend the next several years, at least the majority of the next several years, below the inflation rate, because there's collateral shortages, There's things like spillover effects, where if Japan holds their rate zero, then some of those buyers come out and they buy U.S. Treasuries, even if they're not yielding as high as inflation. And so I think that that could vary. I mean, there's obviously different forces that could impact that. And so, but I think we're probably going to be in a range that is below the inflation rate.
Does money printing actually cause deflation, maybe slightly reposition outside of asset inflation? Does money printing cause deflation?
I would say not necessarily, but there's that's one of those really nuanced things because uh, you know, money printing does not really boost, say, CPI because it doesn't get out into the public. But when you combine that with fiscal spending, so if the fiscal authority does some sort of stimulus, and then a large portion of the bond issuance for that is monetized, is bought by money printing, that is inflationary. And so we've seen, for example, in Japan, I think a closer thing to track is not what's happening with base money. So base money can go vertical, and that's not necessarily going to tell you almost anything about inflation or deflation. Instead, a closer variable to watch is broad money. And so if you look at Japan, for example, Japan has had very, very slow broad money supply growth over the past 10 years. And that's because corporations have deleveraged at a time when the public sector leveraged up, mostly financed by the central bank. So their base money, their central bank balance sheet went vertical, went over 100% of GDP, whereas their broad money supply was super slow. And whereas in the United States, on the other hand, we've been seeing a faster broad money supply growth because our deficits have been bigger. We've had a different phenomenon there. And so I would say there's a lot of nuances there, but I think investors are
Sure.
much more profitable if they follow broad money rather than base money.
Last question. What would cause the US to lose? Doesn't sound like it's going to happen anytime soon, but to lose its reserve currency status.
So the short answer is not much. The longer answer is I think we're seeing a gradual shift towards multiple, like, regional reserve currencies. So
Yeah.
so a handful of currencies that are able to buy oil and other commodities. So basically the since the 70s, really the United States is really the only currency you can reliably buy oil with, from most places, other than a couple outlier times like Iraq or others that decided to sell in euros. But we're starting to see a pretty tangible effect there where Russia is now selling their oil in euros. And so we see trade between Russia and Europe is becoming less dollarized and more euroized. We're also seeing that trade between Russia and China is being de-dollarized and more euroized. And so not even so partially their own currencies, but then also the euro, even though neither of those obviously use the euro. And so I do think we're seeing a shift towards regional reserve currencies where the dollar's share of global central bank reserves will continue to diminish, and that we'll see a couple different major currencies like the dollar, the euro, and probably eventually the digital yuan that are increasingly used to buy oil, but not that there's a new global reserve currency, but you have a little bit more of a decentralization or a dilutive effect. So you have maybe top three currencies.
For sure. It looks like eventually inevitable, but not anywhere in the short term. I do absolutely have some questions in the tank for the next time. I think we kept these, whatever, 40 questions. I think only 2 or 3 were repetitive from the last time. So quite the task coming up at new questions, but it was a lot of fun. For those that would like to, and I highly recommend, follow you on Twitter, what is your Twitter handle?
So I'm at Lyn Alden Contact on Twitter, and my website is lynalden.com.
So again, that's Lyn Alden Contact on Twitter, and the same for the website where you give away a lot of free newsletters. I recommend paying. It's cost effective like I am and being a subscriber. So I highly, highly recommend it. Is there any other information or medium of exchange where people could learn more about you or subscribe to?
Those are the main ones, my website and Twitter. I also have a free newsletter. So if someone just wants to join the free newsletter on my website, that comes out every 6 weeks. So they can get a taste of that, and it's for free.
Yeah, I mean, I'm like the biggest fan of Lyn. I think she's great. It was an honor again to interview her for the second time. Look forward to the next time. I learned so much. I can't wait to go back and watch and listen to so I could better absorb and take notes and make some changes or rethink things as I think for myself some decisions in terms of that I'm making. Thank you so much, Lyn. If you have to run right now, it's all good. I'm going to give a 1 minute close to wrap things up and we're good. But I appreciate your time. And again, very much look forward to the next time.
Yep. Thanks for having me. Bye,
Thank you.
everyone.
Bye. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, or simply Family Office on YouTube. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth in their family offices. You can learn about us on our website, very simply our name, FamilyOfficeAssociation.com. We encourage you to look into membership and be a part of our special community. I'm also very active in social media. Again, as I mentioned earlier, we're Family Office Association on Instagram, and I do some unique things there. So we're a little different, and you may get some value out of that. And I'm Family Office, as mentioned, on YouTube. On that note, enough about that. Lyn was great. I look forward to the next time. Thank you to our live participants, much of them members of Family Office Association. I appreciate it and look forward again to the next time. Thank you.